Good afternoon, everyone. Thanks very much for being here today. Over the past year, the economy has been growing at a strong pace. The unemployment rate has been near record lows, and inflation has been low and stable. All of those things remain true today. Since the September meeting of the FOMC, however, some cross-currents have emerged. I'll explain how my colleagues and I are incorporating those cross-currents into our judgments about the outlook and the appropriate course of policy. Since September, the U.S. economy has continued to perform well, roughly in line with our expectations. The economy has been adding jobs at a pace that will continue bringing the unemployment rate down over time. Wages have moved up for workers across a wide range of occupations, a welcome development. Inflation has remained low and stable and is ending the year a bit more subdued than most had expected. Although some American families and communities continue to struggle and some longer-term economic problems remain, the strong economy is benefiting many Americans. Despite this robust economic backdrop and our expectation for healthy growth, we have seen developments that may signal some softening relative to what we were expecting a few months ago. Growth in other economies around the world has moderated somewhat over the course of 2018, albeit to still solid levels. At the same time, financial market volatility has increased over the past couple of months, and overall financial conditions have tightened. That is, they have become less supportive of growth. In our view, these developments have not fundamentally altered the outlook. Most FOMC participants have instead modestly lowered their growth and inflation forecasts for next year. The projections of committee participants released today show growth continuing at healthy levels, the unemployment rate falling a bit further next year, and inflation remaining near 2%. The projections also show a modestly lower path for the federal funds rate, which should support the economy and keep us near our goals. The committee held our policy rate near zero for 7 years to give the economy the best chance to recover. Today, we raised our target range for the short-term interest rates by another 1/4 percentage point. As I've mentioned, most of my colleagues expect the economy to continue to perform well in the coming year. Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year. Today, instead, we see growth moderating ahead. What kind of year will 2019 be? We know that the economy may not be as kind to our forecasts next year as it was this year. History attests that unforeseen events as the year unfolds may buffet the economy and call for more than a slight change from the policy projections released today. With that caveat, there are 2 important differences in the policy outlook today versus next year. In early 2018, we saw a rising trajectory for growth. Today, instead, we see growth moderating ahead. FOMC participants, along with many other forecasters, had long predicted some moderation of growth in 2019. The additional tightening of financial conditions we've seen over the past couple months, along with signs of somewhat weaker growth abroad, have also led us to mark down growth and inflation projections a bit. The median of FOMC participants' projections shows growth of 3% this year and 2.3% in 2019. With growth remaining next year above its longer-run normal value, the unemployment rate is projected to fall a bit further to 3.5% by the end of 2019. Inflation in the median projection remains near 2%. Second, the economy has continued to strengthen this year, and given our 4 rate increases and the ongoing reduction in our portfolio, monetary policy will be providing a smaller boost to the economy in 2019. After today's action, the target range for the federal funds rate is 2.25% to 2.5%, putting it at the lower end of the range of estimates of the longer-run normal rate provided by the committee. Since the financial crisis, and during that period, we've had low unemployment and strong growth, and inflation